Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. You're watching Indian Open and I am Neeraj Shah. Let's take it straight to the headlines at this hour. Urjit Patel hits back at RBI's critics, says no regulator can prevent all frauds, adds that RBI has limited regulatory powers over PSU banks. Trump's latest economic advisor, Larry Kudlow, hints that US will take a tougher stand on China and trade. Binani Cement's creditors backed Dalmia Bharat's bid for the Stred's assets. And 65 anchor investors blocked their share in Bandhan Bank's IPO, which opens today. That's a large one to monitor, and we will monitor during the course of First Word, as also during the course of the day as well. Let's take a quick look at how the trade setup is looking like. Remember, markets seem to be stuck in this very, very narrow range, and every rise is being sold into. This is not new news, but yesterday the broader end of the spectrum, which was looking extremely strong day before yesterday, came off quite rapidly in the session as well. So that the template seems to be followed to the T. I think DI selling in select pockets is not helping the cause either. And no support coming in from that end of the spectrum, or no necessary support or adequate support coming in from that end of the spectrum as well. We're watching out for two pockets in the session today, to be honest. One is the late recovery in private sector banks, and if that continues in today's session, could well help the Nifty bank and therefore some support to the indices as well. Almost all of the private banks, without an exception, went up in the last half an hour of trade yesterday. So that's a very important pocket to watch out for. Does give a big leap to the Nifty bank and thereby to the Nifty. So that's something that we will watch out for. And it was an interesting day or an interesting last 1 hour for the media stocks in trade. Everything from a Dish TV to a Sun TV, so essentially distribution, broadcasting, almost all of that set of names went up really well. Nifty Media, as a result, ended up about 1.5% yesterday. To be honest, amongst the noticeable pockets in trade, this one stood out. Let's wait and watch what happens to that pocket in the session today. The stocks that we'll be watching out for in trade, I mean, there's about 5 or 6 odd names, so I will watch out for 3 or 4, the ones that I thought were the most important. I have brought out Dalmia Bharat, and we'll be talking about that in details on First Word too. But the group may win the lenders backing for Binani Cement. I believe Vishwanath Nair has also got some confirmations from the lenders, so we'll get a check on that and what it means for Dalmia Bharat as well. So that is one key stock. This is the TOI report, of course. Canfin Homes, HDFC eyeing that stake, has filed the binding cash and stock offer. I think as per the note in Times of India, Canfin Homes is valued at about $1 billion. Let's see if there is some reaction thereof in Canfin Homes. As also in HDI, again a Times of India report, wherein MADA has accused the subsidiary of HDI for a 1,200 crore fraud. It's a stock that's really not given any returns since demonetization lows, since the time the demon rally started. A clutch of other real estate names doing well, this one not so. Now a further nail in the coffin, or not a nail in the coffin really, but some bit of problems for HDIL. Let's see if this one reacts further or no. And AB Capital could be an interesting one as well in the session today. And then, of course, as I said, a bunch of other names, the media names, select names on the NBFC space as well. All of those would be watched out for. But I think the thing that created the buzz yesterday evening was Urjit Patel. And today on First Word, we start off by discussing why Urjit Patel wants more regulatory power over PSU banks with former Finance Secretary Arvind Mayaram. Of course, Vishwanath Nair Johnson to talk about his thoughts as well. Binani Cement lenders will back Dalmia Bharat-led consortium at the NCLT, even though Ultratech has offered more. And continuing with cement, we talk about how cement companies have shrugged off the pricing worries and look at what may be siding their strength. And as the last piece, we take a look at the primary markets and what's on offer in the Bandhan Bank IPO and what sets its portfolio apart. Let's start off with the main chat. After facing strong criticism for not being able to prevent the PNB fraud, the RBI Governor has now set the record straight, or made an attempt to do that. In a passionate speech last evening, Urjit Patel blamed limited regulatory powers over the state-owned banks for the recurring issues at these lenders. Let's first get in Vishwanath Nair, who joins in with the big takeaways for that speech? Well, Vishwanath, we were talking about busy 12 hours. I think it's a busy 36 hours now, and Urjit Patel ensured that.
Keeps giving. So the Reserve Bank governor's speech came out late last evening. You know, and I'm glad you used the word passionate, because that's exactly the kind of tone that he's used in the speech. He's made quite a few metaphors and used these complex methodological concepts to explain how the RBI is involved in cleaning up the banks and how probably the system is pitted against the Reserve Bank of India. First and foremost, he points out how the Banking Regulations Act essentially ensures that the way the RBI regulates a private bank and the way the RBI regulates a government bank are completely different. In terms of the government bank, that power is split between the RBI and the Finance Ministry. There is some sort of dual regulation which is causing a fissure, is what he's saying, and that is obviously going to be an issue that that they have to deal with. Also, he points out that there has been this tendency of people to simply blame the RBI every time some kind of fraud comes up. He says that it's not fair. It's not feasible for an organization like the RBI to completely eradicate every single fraud from the system. It's not possible. At best, what the RBI and similar monetary authorities can do is limit the number of frauds and limit the number of people who are affected by the frauds. That's about it. You can't go beyond that. He also says that everybody thinks of RBI as this very stoic organization that is not impacted by anything, but they are angry and they're hurt whenever something like this happens in the banking industry. He says it's akin to looting the country's future. Yeah. There's the passionate bit in the speech, of course, but it's
not true.
To them. It's not false.
Which is not false, sorry.
It's not false, yeah. So he says that businessmen get in with some lenders and then they perpetuate this fraud, and then the RBI is pulled up for it. He's saying it's unfair because A, you don't let us fully regulate them, and then B, you expect us to stop every single mistake that may happen with it. Last and most important bit, however, is the NPA regulation and the stressed asset management bit, which he says that this opportunity with the PNB and the governance conversation being started, this has to be used to deal with that NPA problem ASAP. Because if you don't deal with that NPA problem, you're going to head it for a real big problem later on in probably a year to come. He's saying deal with it now. And let's get away from this NPA problem and move on for the public sector banking system, which controls about 70% of the lending in the country. So it's a massive chunk of lending, right? He's saying it doesn't matter. The RBI is ready to take whatever brickbats are there till the point this process is completed. We will take whatever hate comes our way. But let's ensure that this process is completed and not, you don't get distracted by all these other conversations that are happening. So pretty passionate speech like that.
Great. Join me in the conversation with our next guest, Vishwanath, who better to talk about all of this and more than former Finance Secretary Arvind Mayaram. He joins us right now on the phone line from Jaipur. Mr. Mayaram, good morning, and thank you so much for taking the time out this early in the morning and speaking to us at Bloomberg Quint. What did you make of these 3 or 4 standout points that came out? More a case of defense or more a case of points to ponder, or what can really be done in order to improve the system?
No, I think the governor has made some very valid points, and one must sit back and think about it. It is very true that the dual control of PSU banks has caused a lot of problems in the past also. The issue is that if you have a banking regulator, you cannot have 2 different sets of regulation, because they are also against the principles of competition, which I think is becoming more and more important now as the economy grows and becomes more mature. So I think he's made a good point. There is case for reform on that side. While there may be some merit in government having some PSU banks for the purposes of balancing the market, but it is also important that these PSU banks are governed in the same manner under the regulatory regime as the private banks are.
Right, Mr. Mayaram, this is Vishwanath here. Trying to understand what could possibly then be a solution. Will the government then need to just stay away from public sector banks completely, probably reduce their stake? This has been a conversation that has been going on for years, but nothing has actually fructified out of it. So what do you think, sir?
Like I mentioned, if there may be some merit in some banks to remain in the public sector, but they can still be companies under the Companies Act. They can be banking companies. So they should, one, move out of this protective cover of being government-owned companies, so therefore they'll be treated differently from the other banks. So regulator can regulate. As far as banking regulation is concerned, the PSU banks should be subject to the same regulation as the private banks. However, the ownership issue is different from this. I mean, whoever is the owner, it does not matter who the owner is, but regulation remains the same. I mean, today the banks can be owned by different entities, but regulation remains the same. So we must not mix up the two issues of ownership and regulation. I think these are two different issues. I mean, in terms of how we are going to, further reform the PSU banks and whether government should have majority stake there or not is a different question. But what we are speaking about today is how they should be regulated.
Right. Also, he points out about NPA management and, that being the primary focus that should be there for regulators as well as the government. But it's a problem that you've been, the banking system has been facing for the last 5 years. They've been the regulator has been very aggressively pushing for a cleanup. Again, nothing has really fructified. All you've seen is an increase in the number of NPA, but no resolution. So then what can be done there?
No, now you have the bankruptcy law is there already in place. And the RBI has been tasked to identify large defaulters and then take their case, and so their management can be changed so that things can happen. Now, the NPAs will have to, of the management of the companies can be taken over and so on if they have been defaulting. So there must be a rapid movement on that side. And if some results are seen very quickly, I think it will have a salutary impact on the market. I mean, you cannot do 100%, treatment of all the defaults in one go. But if some large examples are set, it is going to have a salutary impact on how the corporates behave as far as their debt is concerned.
Then that probably the government's involvement or this dual regulation bit that plays a part in the NPA numbers.
Again, I think we are confusing issues. NPAs relate to defaults by the corporates, right? And you are talking about PSU banks, but the default is by the corporates. And therefore, the PSU banks can also take these corporates to the launderer and get their management changed, or they can take over the assets and they can strip the assets, and so all those things can still be done. So what does
I agree with you on that point, Mr. Mayaram, but the problem that the regulator, that the RBI governor also pointed out, is that public sector banks are just not doing that. That while they have this power and they have this responsibility, they're just not doing it. And one of the reasons he's pointing out is the dual regulation.
No, so that's why I'm explaining. So I first said, I agree with the governor that there is a need for reform to bring the PSU banks under the same regulator or under the same regulation. And secondly, the PSU banks must push hard to get some of these NPAs, especially large NPAs, taken to the bankruptcy, under the bankruptcy code. And it is for now the resolution to happen quickly on those, so that there is an example which is set. So it is a concerted effort by everybody. That's not just the RBI, but government, RBI, and the PSU banks all will have to work in concert.
You reckon that the comment by the Reserve Bank Governor that if the Banking Regulation Act strengthened would help the Reserve Bank, or both the government and the Reserve Bank, to deal with this menace of the NPAs and the PSU banks a lot more effectively than it's being done currently, Mr. Mayaram?
No, I don't think that is enough. I think RBI also is remiss in one fact, that their own regulations are not really looking at a large number of issues like conflict of interest within the functioning of the banking sector. And therefore, it is not just one part of it that, now that the government gives away its regulatory authority to the RBI, things will fall in place. It doesn't work like that. I'll give you one very small example. I'll give you this example of, you have, when you issue bonds, the SEBI requires debenture trustee to be appointed, which will be a third party, which will validate the assets, underlying assets of that bond and ensure that at all times the bonds are backed by the assets. Now, this is not true in terms of loans that the banks are giving to anybody. Now, what happens most of the time is, if you have mortgages, for instance, if you have sureties or securities which are given to the banks, these banks have themselves now established their own trustee companies. So each bank, most of the banks have their own individual trustee companies. And these trustee companies are now tasked to take care of the sureties and securities. Now, how does that work? There's a conflict of interest there. The ownership of the trustee company is of the bank, and the bank is now asking this as a third party to ensure that all the securities that have been given for loans or have not been given, then contingent liabilities that arise from that are properly accounted for. It doesn't work in that sense. So there is a lot of conflict of interest happening in the banking industry today, which the RBI should be mindful of and should be looking at. This is a system reform within the banking sector. It is not just PSUs, but even private banks. But the RBI must also look at its own regulation and see how, it is really working on the ground.
Yeah, well, I'm sure this is probably one example. There would probably be more such things as well that need to be looked at. But I'm glad we had this conversation this early in the morning, Mr. Mayaram. Thank you so much for taking the time out and speaking with us today.
Thank you. Thank you very much.
Well, that's the former Finance Secretary Arvind Mayaram speaking about his thoughts. Clearly agreeing with the RBI Governor on a bunch of things, but maybe a lot more needs to be done than just simply strengthening the Banking Regulation Act. But yes. By the way, we're not done with this. About 8:19, but still have a couple of very interesting stories to cover. The other interesting story that we've been tracking at it, moving off from banking onto cement and the whole process in CLT.
Still a large banking chunk there. So.
Still a large banking chunk there, yes. But I think we've gotten some hints about Dalmia being the preferred bidder.
The lenders had been assessing the bids in the Binani Cements case. It was under insolvency. 2 bids came in, Ultratech and consortium led by Dalmia. Dalmia is backed by this Piramal Bain Fund, the India Resurgence Fund it's called. So they're funding this deal, but the Dalmia guys will be the operational part, of course. It seems that the lenders had a meeting yesterday, and they have approved Dalmia to be the bidder who has won the bid, and they will be backing this. So there is an important distinction saying that the lenders are backing them because there is a huge controversy associated with it. Now let's look at the bid first. It's about 6,350, 6,400 odd crore that Dalmia has bid for the company, and this covers a large part of the debt that Binani Cements has. So it's obviously going to help lenders take that call. It makes things easier for them because there's barely any haircut in the case. What happened in the Ultratech bid was that Ultratech was very close to what Binani was, what Dalmia was, but it ended up being in Dalmia's favor, which Ultratech obviously didn't like, and then they went to the NCLT. They said that they should be considered as the highest bidder, and then lenders should be negotiating with them. Alongside that, they also submitted a revised bid to the lenders, wherein they hiked up the money that the amount of money that they're going to offer. More than 7,000 odd crore is what our sources are telling us. They were willing to offer that money, but it turns out that the lenders did not want to take Ultratech's bid at all. The reason is because apparently this is what the lenders are telling us, is that there is a CCI observation of cartelization against Ultratech, which sort of makes them ineligible to bid for this asset. Of course, Ultratech has objected to this cartelization order previously, and they are fighting it. But at this point in time, the lenders don't want to take that kind of uncertainty, so they would rather take up Dalmia's bid. So that's what has happened now.
Well, in all probability, Dalmia emerges a winner and gets a strong foothold into a region that it really desperately wants to strengthen itself in as well. Well, Vishwanath, thank you so much for taking the time out and being with us today this morning. Speaking of cement, just a quick word really on what's happening within that pocket as well. In the last 4 or 5 days, we've seen cement stocks really go through, well, not really through the roof, but compared to what the markets have done, the cement stocks have done extremely well. So what is it that has changed, and has something indeed changed? I've omitted Ultratech and Dalmia from this set of stocks, but just look at what 3 or 4 of these names have done. Sanghi, ACC, Shree Cement, India Cement. The last 4 days, almost each of these has about a 4 to 5% to 7% kind of a gain that have come in. Now, what could be working? I think a JP Morgan note, for example, says that the Q3 FY18 demand growth in mid-teens was strong, but demand is holding well in January and February as well. So JP Morgan's internal checks seem to suggest the demand which picked up in October to December has only sustained in Jan and the month of February. And the impact of Rajasthan's sand mining ban, very, very negligible, because sand mining issues by and large have eased. In fact, CLSA as well came out with a note yesterday, and they mentioned the same thing, that while 2017 was perhaps the worst year in terms of sand availability, states have revisited the rules, they have eased them, and the issues should be by and large resolved in 2018. So some large brokerages have gone out and done some ground checks on cement, and seems that the sand availability issues for construction, which will have an impact on cement, have eased, and eased quite considerably. I decided to take a quick check at what the valuations are looking like, and on an EV per ton basis, if you just look at almost all of the stocks, save for Shree, which is perennially in the expensive zone, and Ultratech, which is also northwards of 206, almost all of the others are trading in or around the levels that they have traded for a really long time now on an EV per ton basis. And while I don't have the EV to EBITDA charts, if you just looked at what ACC or an Ambuja or some of the others are doing, the ranges that they trade in, they are trading very close to the bottom end of the trend from where the EBITDA levels tend to bounce off. So there is some merit in looking at history and trying and figure out what could the cement companies do, and that is the valuation bit. But fundamentally, a lot of issues, particularly the sand availability issues and the demand issues, seems to be easing off. Higher demand in East, Central, North region would probably do well, and rural housing, which is doing extremely well across the board, or showing signs of starting to do extremely well across the board. And I think that graph depicts itself properly. Almost all over the country, the rural housing demand is seemingly very, very strong, and all of that could work for cement, in addition to the plethora of road orders that are coming in, and probably could augur well for the cement demand as well. So do watch out for this pocket, a 4 or 5% kind of a rally having done already. Maybe not too many trading gains left on the table, but it could be a very interesting year, 2018, for the cement names. Well, that's not all. The last piece on First Word today it speaks about being a very interesting year for microfinance, SFBs, and this whole NBFC space. The first microfinance lender to get a universal banking permit, Bandhan Bank, is now headed to the bourses. It looks to raise about 4,473 crore rupees through its IPO. Shraddha, who spoke about this last week in brief, is standing by with the complete details, and what should investors be watching out for in the IPO. Shraddha, good morning.
Good morning, Neeraj. So starting off with, it's IPO where they're looking to raise 4,473 crores, fresh issue of 3,662 crores, and the remaining 811 is offer for sale by two existing investors, IFC and IFC-FIG, both of which are arms of the World Bank. So the price band has been fixed at 370 to 375, and at the upper price band it would imply a post-issue market capitalization of 44,730 crores. So that will actually peg it ahead not only of some of the NBFC turned banking entities like AU Small Finance Bank, Equities or Ujjivan, but also much ahead of some of the mid-cap private banks like IDFC Bank, Federal Bank or RBL Bank. So Bandhan will rank much higher as far as that is concerned. If you look at the shareholding profile, the promoter Bandhan Financial Holdings had about 89% stake in the bank, which will come down to 82% after this issue. And this was mainly being done because of the RBI's mandate that the bank will have to list within 3 years of starting its operations.
Shraddha, that's about the IPO, but Bandhan Bank also has an interesting business mix. Tell us about it.
Okay, so they of course started off before the banking operations. They were India's largest microfinance company, and then they started the banking operations in August 2015 after receiving RBI's universal banking license. So they have about 887 branches across 3 states. So the concentration is in the 3 states of West Bengal, Bihar and Assam itself, and in fact most of their customers are actually women. So now if you look at their loan book and how that has changed since they began their microfinance, since their banking operations from just being a microfinance player, micro loans still forms a sizable or dominant part of the portfolio at 88%. They're trying to scale up the other retail loans bit, which is about 3% right now. So other retail loans include two-wheeler loans, home mortgage loans and gold loans. So that's one of the bank's strategy to be able to diversify. Now, if you look at the bank's financials, look at how they've been able to scale up their balance sheet. Loans in a short period of time have grown from 12,000 crores to 22,000 crores. Deposits have risen from 12,000 crores to 25,000 crores. So it really shows how they've been able to scale up that entire balance sheet in a short span of time. Even if you compare it with some of the peers, now Bandhan Bank's gross NPA is at a much healthier 1.67%, which shows that they were able to manage even events like demonetization much better than what Ujjivan Financial was actually, or Equities was able to do when their gross NPAs shot up sharply. Even if you look at some of the other operational parameters, in terms of the net interest margin, Bandhan Bank's number stands at 9.9%, one of the highest in the industry. The CASA ratio has also been relatively higher at 33%, so a strong liability franchise build up, even something that a IDFC bank hasn't been able to do, or a RBL hasn't caught up to as well. And in terms of the cost to income ratio, now this is the USP as far as Bandhan Bank is concerned. It stands at one of the lowest in the industries at 35%. So they've been able to maintain their cost structures really, really well, despite all this branch expansion and investment that they are making. But when it comes to the return ratios as well, the ROAs amongst the highest at 4.5%, ROE at 28%. This could come down, of course, after the IPO, but analysts still believe that the return profile will remain superior compared to the peers. Most important aspect when it comes to valuations, on a 9-month FY18 post-issue basis, Bandhan Bank at the upper price band will be valued at 4.9% price to book, which is a lot more pricier than some of the NBFC or MFI turned banking entities like Equities or even Ujjivan Financial, both trading between 2 to 2.5 times. And it is actually asking for a valuation close to the likes of HDFC Bank at 5.3. So valuations really are undoubtedly pricey. But despite that, most of the brokerages have recommended a subscribe that's coming in from Antique, ICICI Securities and IIFL Wealth Management. Centrum has said that you should subscribe only for long term given the pricey valuations, and they see limited listing gains. But nevertheless, strong cost structures, the return profile, margin profile and the limited earnings history that we have since the commercial operations began definitely set a strong background as far as Bandhan Bank are concerned.
Well, let's wait and watch. The IPO opens for subscription today. We'll get to know. But if you wanted to know what the key numbers were, Shraddha's told you that, and most brokerages believe that it's worth subscribing to the IPO. So there you have it. If you are indeed contemplating investing in Bandhan Bank, this is all that you need to know. And that's all that we have on First Word today. Stay tuned though. We'll discuss, we'll pick Sanjeev Prasad's brains. He joins us from Kotak Institutional Equities. We'll pick his brains on what does he believe is in store for 2018. And we have a very interesting conversation with media industry veteran Sameer Nair about what could change within the media space, and how would companies and platforms monetize that? All of that coming up a bit later on. For now, slip into a break. Come back with full tilt towards the day's trade on the other side.
आइसक्रीम? ये है डबल आनंद। पहला आनंद पॉलिसी टर्म के अंत पर मैच्योरिटी क्लेम का पूरा भुगतान, और दूसरा आपके अपनों के लिए लाइफ कवर की पूरी रकम बिना किसी प्रीमियम के। LIC न्यू जीवन आनंद, आनंद ही आनंद।
सॉरी, आई एम लेट। क्या हुआ?
कुछ नहीं यार, जस्ट वर्किंग ऑन माई एक्सपेंशन प्लान।
फंडिंग का चक्कर।
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख। ला।
अरे।
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल।
हाँ।
NSE Merge, साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
On 26 November 1949, the Constitution of India was adopted, recognizing liberty, equality, and fraternity as the principles of life, which cannot be separated from each other. The government of Karnataka has imbibed the ethos of the Constitution by developing programs and policies aimed at creating a socially, economically, and politically just society. Karnataka's flagship programs such as Maitri, Annabhagya, and Arivu have created an equal opportunity platform for all, irrespective of their gender, economic, or social status. Karnataka is committed to encourage education through various welfare initiatives, ensuring equal status for women and empowering minorities to uphold every individual's dignity. In the last 4 years, Karnataka has formed 462 new Gram Panchayats, which has taken the principles of democracy to the grassroots levels, and our Progressive Vision 2025 document engages public government participation to build a better state for all. Karnataka's collective vision to endorse fraternity, justice, and equality has transformed into Karnataka's model of development, which is based on the tenets of the Constitution.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Welcome back. You're watching Indian Open on Bloomberg Quint. Let's see how the Asian markets are faring out. And there seems to be a smart recovery that's coming in. The Hong Kong markets are up in the green now. Japan, which was down over close to 1%, has managed to recover. The Chinese markets are trading absolutely flat. But the SGX Nifty, that's very surprising. It was down almost 70 points at one point of time. Now just down 20 points. So still there is almost an hour to go before trade actually starts. So there will be more changes that we can see on the SGX Nifty. But it was very interesting as far as the F&O markets was concerned. Navneet Saluja joins us. Navneet, very interesting yesterday. Significant amount of call writing at the 10,400 level. Is the level shifting down lower by 100 points again now?
Well, Darshan, towards the start of the series only we did see the base for the market moving lower. So 10,400 definitely added a lot of OI. I'll get to that. But Nifty, which did recover actually towards the end of the session, there was no major open interest build-up, as you can see, just about flattish. But the Bank Nifty, that's going to be in focus today. Today is Thursday. We'll have the Bank Nifty weekly options. They expire. And if you look at the maximum open interest concentration for this weekly series, it is at 25,200 call and the 24,500 put. So watch out for this wide range in today's trading session. And remember, yesterday there was a sharp recovery towards the second half of the session for the PSU as well as the private banking space. The India VIX, which fell in the start, but towards the end, it ended off day's low. So 14.3 was the level where India Volatility Index yesterday closed. Coming to the option strikes, which Darshan was mentioning, 10,400 strike. Well, closer to 10 lakh shares were added here. So this is a very important level. The call right is here. If you look at the premium, that's somewhere about 90-95. So till the time index trades around the levels of 10,500, they'll be safe. But if it crosses that, probably you can start to see some unwinding. And even the lower level put strikes, 10,100 put strike, added the maximum OI in yesterday's trade. Let's tell you what the FIs did. Well, they sold in the cash segment yesterday, but there was some bit of short positions being built up on the stock index futures. Almost 10,000 contracts were added here, even on the options side, where in the last 2 to 3 trading sessions, we were seeing FIs building a bit of long positions. But yesterday, let's pull up the index options plate. That's going to tell you we did see some bit of addition coming in for the put long as well as the call short side. Lastly, the stock futures to keep an eye on. 2 new entrants in terms of F&O ban. Watch out for Bank of India and also the TV18. In fact, watch out for the entire media pocket in the last hour of trade yesterday. There was a sharp surge for stocks like Dish TV, Sun TV, and also TV18. I'm also going to watch out for NIT Tech. Remember, this counter has been an outperformer. If you look at this year, up 44%. Huge amount of long build-up was seen for NIT Tech.
Okay, thanks, Navneet. We'll certainly watch out for the companies in the F&O ban and NIT Tech in particular. So, but time to get in more views on the fundamental side. Avinash Gorakshakar of Joindre Capital joins us. Good morning, Avinash. Firstly, in terms of this news that's happening as far as the entire Binani Cement, Ultratech and Dalmia is concerned, how do you play this out? How will this go? Because now Dalmia has said that they are looking to back this one. Any view on that?
No, I think Darshan, clearly what kind of valuation Dalmia gives for Binani is going to be a key fact, because I think Ultratech had already sounded that they were very keen to take over this asset. So I think it's going to be a catch up on the valuation part. I think my guess is it's going to be definitely a prized asset for both these companies, and going forward typically you could see a little bit of timeline before we get a clear amount of valuation. But I would believe that Ultratech, if it does get it, it actually increases.
So lenders, Avinash, have stated that they are backing the Dalmia bid. In all probability, Dalmia is going to get it now. Ultratech is out of the race.
I think clearly then, obviously, if lenders give the green signal, Neeraj, then obviously it's a done deal, and probably that could be obviously a big positive for Dalmia, because clearly I think in these cases, I think the green signal from the lenders is very important.
So what would it mean for Dalmia as a stock here on? They are a large player, they're an expensive player, but now they get a foothold into a market that they wanted with a large capacity as well.
I would believe that these kind of acquisitions, you probably require 3 to 6 months before we see the integration happening and possibly numbers getting consolidated. I would believe that probably FY19 second half could be somewhat better, and probably you could see some moves more on the volume share, because I think volumes would definitely be a big kind of a booster for Dalmia.
Okay. The other stock that I wanted your view on was AB Capital. Now, yesterday they said that they've received the ARC business approvals from the RBI. They will start the ARC business, but something is definitely missing. The stock is trading at record lows actually. So somehow, after the Premji investment deal, and everyone said that was done at a high valuation, nothing's actually played out for this counter.
No, I think, Darshan, nothing has played out for the counter, but if you see the Q3 numbers, I think, the market was expecting something very radically, very significant, and expectations were running very high. So I think clearly it's not that the business is not growing. They are into segments like the mutual funds, the housing finance business, the insurance business. So I think these are all long-term plays, and I would believe that, you need to give in some more time, because, from the time of the listing, obviously the underperformance is quite visible. But business-wise, I think they are present in pockets like affordable housing, they are present into insurance. So I think it's a matter of time before we could see a good upside, and the ARC business was a long-awaited kind of, watch from the market standpoint. So I would believe that, yes, somebody who's got a long-term view, Darshan, could still make money, but yes, in the shorter term, this stock has disappointed a lot of investors.
Okay, hold on, Avinash, our research team is ready. Lots of news, lots of stocks that you need to watch out for. A lot of important news that came out overnight on the fertilizer space. So Yash will be speaking about that. Shraddha will be talking about which are the stocks that you need to watch out for. And an important M&M investor meet that happened yesterday. What are the key takeaways? We'll find out. But Yash, first to you. Important news coming out from the fertilizer sector in terms of urea and non-urea both. But what is the impact? Which are the stocks that will get impacted? But first, start with the news.
So basically, the entire fertilizer pack will be in focus today. So do watch out for GNFC, RCF, National Fertilizer, among others. So basically, what has happened is that the cabinet on Wednesday evening has accorded its approval to implement the direct benefit transfer scheme for the fertilizer subsidy payments, and has also given the approval for extension of the urea subsidy scheme beyond the 12 5-year plan. Now, it is estimated to cost the government about 1.64 lakh crore rupees, and both the schemes are likely to help these fertilizer companies in terms of speedier disbursements and reducing the working capital requirements. So we'll be watching out for this space today.
Okay, watch out for the fertilizer space. Shraddha, which are the important stocks that we need to focus on?
Darshan, starting off with ICICI Bank, because they will sell 7.72 crore shares of ICICI Securities, which is ready or headed for an IPO, which will open on 22nd March. Now, it's not a very big, or it won't impact ICICI Bank too much, because as far as ICICI Securities contribution to the total SOTP based valuation of ICICI Bank is concerned, it contributes just about 5 or 6% according to analysts. So some marginal impact that we could see. You also have Canfin Homes, which will be in focus, and this is on the back of a Times of India report which says that HDFC has emerged as a front runner to buy Canara Bank's 30% stake in Canfin Homes. In fact, they are said to have filed for a binding cash cum stock offer, under which they will offer cash for 14% stake upfront, and for the remaining 16% stake buy, there will be a share swap. So let's see how Canfin Homes reacts today. Wipro will sell its hosted data center services operations to US-based Ensono for $400 million, and in turn, Wipro will invest $55 million in the company to pick up a minority stake. Havells India, they've signed an agreement with Hyundai Electric to manufacture magnetic contactors. You have HUL, which has offered the third tranche of GST benefits, and according to Times of India report, they've offered another 36 crores for the month of January. And lastly, Welspun Enterprises, a negative development that we could see there. Now, NHAI has re-invited bids for a Tamil Nadu road project for which Welspun was actually L1, so we could see some negative reaction there, Darsh.
Okay, so that's the view that's coming in some of the stocks. And interesting M&M Investor Day meet. So what were the key takeaways?
So M&M first up is to introduce 4 new CNG engines across capacities in FY 19-20. Now the company have also developed a BS6 compliant diesel engine at a significant lower cost, which is 50% lower than the current models. Now in the utility vehicle space, the M&M looks to launch 4 new models in near term, of which 2 such models are likely to launch before November 2018 in the volume segment. While in the commercial vehicle space, they plan to introduce new products in first half of financial year 2019 by investing a sum of rupees 600 crores, and they expect EBITDA break-even in the space by financial year 2019 itself. Elsewhere, they expect overall tractor industry to grow at a pace of 8 to 10%, and their new Trek Start brand, which is priced 5 to 10% lower as compared to peers, will help them gain market share in the near term. In the electric vehicle space, they have already invested 600 crores, and they expect to invest another 900 crore rupees on technology acquisition in the next 3 to 4 years. M&M also talked about other high potential segments, wherein they expect their agricultural business to touch $1 billion mark in next 5 years, and they estimate their African business to again touch $1 billion mark, to grow by 10 times in next 5 years. Now remember, M&M is number 2 player in Nigeria with 33% market share there. And lastly, they plan to open 7 assembly plants in FY 19, which will bring the total of assembly plants to 15.
Okay, so these are the important stocks that you want to watch out for. Avinash, any view on M&M, the strategy that they outlined in terms of new model launches, in terms of better engines, how will that pan out for M&M going ahead?
No, I think Darshan, definitely, the kind of product launches and the kind of outlook given for the tractor segments is pretty positive. And I would believe that, yes, I think, investors who want to take a long-term view on a pure agri play, I think M&M presents a very solid opportunity if one were to look over the next, say, 12 to 15 months. Another interesting stock which was discussed was Canfin Homes. I think this is one stock which is definitely going to be in the buzz. I think yesterday the management clearly hinted that their entire 30% stake is now put up on sale, and I think there are 6 to 7 bidders. So I think it would be interesting to see how the valuation on the table comes in, but definitely a very strong business in the affordable housing space, which could possibly be a very profitable acquisition for SDFC if it does manage to get it.
So Times of India is saying that's the bid is in and it values Canfin at about $1 billion odd. Is that
I mean, the management has not given a figure for the valuation, but I would believe that looking at their loan book growth and the kind of asset quality they have, definitely, I mean, for SDFC, it actually helps them to get into a market which probably they were not present. So that could be a very solid incremental addition for them.
Okay. Avinash, stay on. We want to talk about the fertilizer space as well, but it's 8:45 or 8:46. So that time of the show, when we're getting our technical experts on board and try and get a sense of how the charts are looking for the markets at large. We then continue our conversation with Avinash, but Kiran Jadhav, Chairman and Managing Director at Kiran Jadhav and Associates, joins us on the show, as does Sameet Chavan, Chief Analyst for Technicals and Derivatives at Angel Broking. Gentlemen, both of you, good morning. Thanks so much for joining in. Sameet, let's start off with you. A bit of a pullback in the private banking space yesterday in late trade, which led to the Nifty Bank and thereby the Nifty recovering quite smartly. For now, it seems like we'll have a start which is flattish to slightly in the red. How would your approach be to trade this morning, both on the Nifty and the private banks at large?
See, as far as directional call is concerned, clearly we are in a sell on rise kind of market, and this is a kind of strategy that we have been maintaining since last 3 to 4 weeks. However, before that, since last few days, Nifty has slipped into a consolidation mode. Now we can see a defined trading range for Nifty, wherein 10,480, 10,500 to act as a very strong resistance, and the low side 10,300, 10,350 would be seen as immediate support. So we expect this consolidation to continue at least before continuing its downward move, wherein on the higher side you could see selling pressure coming in once Nifty reaches its higher end of 10,480, 500. And on the lower side, for a time being, 10,350, 300 would act as a support. So within this consolidation, we are focusing more on individual stocks that have hammered down in the recent past. They are poised for a decent bounce back, some kind of cool off. So that might take place at least for next couple of days, and then probably we might resume its downward move. So as of now, we are looking at the trading range of 10,300, 10,500 for Nifty, wherein we'll focus more on individual stocks. As far as clearly private banking is concerned, if we look at the overall bank Nifty chart structure, on the higher side 25,000, 25,500, which was the earlier breakdown point, would now act as a very strong resistance, and day before yesterday also we saw some kind of selling pressure happening from 25,000 levels. So for a time being, for bank Nifty, we are seeing a range of 24,600 on the low side and 25,000 on the higher side. Wherein if we look at the Nifty PSU Bank Index, it has given a massive recovery in the last couple of days from its important support levels of 2,000 after forming a strong bullish hammer pattern. So PSU banks would also continue its relief rally for a time being, but as far as bank Nifty is concerned, 25,000 to 25,200 is likely to act as a strong resistance.
Okay, so that's the view that's coming in from Sameet. Kiran, what's the range that you are looking at? And the Nifty seems to be indicating a 20-point gap down. So what should one do if he wants to take a trade at the start of today?
Morning. The candlestick patterns for the last 2 days have been really contradictory. Day before yesterday, we saw an inverted hammer. Yesterday, we saw a hammer. Basically, an inverted hammer means that you see selling pressure from the higher levels, and a hammer indicates that you are seeing demand from lower levels. So my break or make levels are 10,475 on the higher side, or you could say a round figure of 10,500. And on the lower side, 10,335 is make or break level. So in between, we'll see yo-yo kind of markets where we'll see alternate bouts of buying and selling, and the markets are really in a confused state of mind. So till the time these two levels are not broken clearly, a fresh position should not be initiated by fresh investors and traders.
What about specific stocks? Kiran, Jadhav, let me start with you first. Couple of recommendations from your end for today.
Yeah, Tech Mahindra is one stock which has been consolidating for a long time with a positive divergence on the charts, strong volumes, strong delivery-based volumes, good open interest additions on the derivative market. So that in kind basically tells us that there's a good kind of demand that is being seen in this counter. So I suggest that one should buy with a stop loss of 630 for a target of 680 in a couple of days. The second would be a TV18 broadcast. Here we have seen pretty good volumes with open interest additions and a good kind of move that was seen in late trade yesterday afternoon. So we believe that this has got a strong potential to move up higher. Therefore, a buy on this counter, stop loss 65, target 73 for today. And next would be another IT stock, KPIT. Here we believe that this has also broken past a range, and we believe that one should buy with a stop loss of 224, target 237.
Okay, we'll certainly watch out for that. But on to our special segment, Bloomberg Edge, where Jayesh Khilnani tells us about a pattern that the Bloomberg terminal has thrown up on the stock. Jayesh, what is the stock on your radar today?
Morning, Darshan. Now, I'm watching out for Aurobindo Pharma, primarily because it is the worst Nifty pharma company so far this year, with a cut of about 16%, and the MACD indicator, which is the moving average convergence divergence, that has given a sell signal indicating there could be further downside as well. Let's have a look at how the MACD actually works. It's a momentum indicator which shows you the relationship between two moving averages. For a couple of lines get plotted, the MACD line, which is the difference between the exponential moving average of 26-day and the 12-day, and the signal line is also a 9-period moving average of the MACD line. What it does is helps you to generate buy and sell signals, and depending on the direction of the crossover between the two lines, you get your buy and sell signals depending on the direction of crossover. Let's have a look at the chart of Aurobindo Pharma. So that's the last 6-month chart that you see on the screen, and you see that there has been a steady decline from about 800 odd levels to sub 600 levels, currently quoting at about 578 rupees. And you can see that there has been a structural downtrend. The bottom panel shows you the MACD and the signal line, and if you zoom into this, you can see that the blue line, which is the MACD line, that has crossed below the white line, which is the signal line, which gives it a potential sell signal.
Okay, thanks a lot for that, Jayesh, putting that into perspective. Sameet, I think we haven't taken your stock recommendations. What is it that you're looking to go long on or go short on today?
It would be one buy, one sell. Sell would be on Tata Steel. We continue to remain cautious on this metal space. As far as Tata Steel is concerned, it has already broken down from its important support levels, and since last couple of days, it's been hovering around its 200-day moving average. Any bounce back from current level would be a good selling opportunity. One can go short around 627, which makes a good risk to reward ratio. Keep a stop loss somewhere around 641. Immediately, target would be 600, but with a slightly broader view, we won't be surprised to see this stock even heading towards 560. Second buy call would be on Divi's Lab. The stock has been consolidating in a range since last couple of weeks. In last couple of days, we've already seen a good recovery, and yesterday the stock was poised for a decent breakout. So we anticipate this breakout to happen today itself, and we continue to recommend this stock for a target of 1104 at least for next 2 to 3 trading sessions. One can buy with a stop loss of 1029.
Okay, we'll certainly watch out for those stocks. Avinash, wanted your view on Century Ply if you track it. Today, CLSA has come out with a note in which they say that MDF will be the new driver, and that is where Century Ply will score over the competitors. Any view on Century Ply? They believe a 30% potential upside.
No, I think for a long time, I think this was one of those companies which the markets as well as the management was very positive post the GST. And I think, the bigger upside for plywood companies, especially companies like Century Ply, is the conversion from the unorganized to the organized sector, which still exists quite significantly. So to that extent, MDF, which is a prominent kind of product contributor now going forward, could definitely, drive the top line and profitability. I think from a longer term point of view, Darshan, this definitely looks to be a very encouraging and a strong kind of pick.
Okay, Kiran, any view on Dr. Reddy's? Because I think the general view that brokerages have put out notes over the past few days indicate that the risk reward is in favor now. How does that look on the charts?
The charts, we don't believe that we should see higher levels for now, but the stock has been stuck in a range. The range on the lower side is 2100, on the higher side is 2250. Till the time we trade in this range, I don't think investors should take a position. But however, if the stock moves above the 2250 mark, we believe that there is a potential upside to around 2500, where the next resistance level exists. So for now, I would avoid taking any positions for that matter. And a close below 2100 will trigger a serious kind of sell-off, which could take the last bottom that we had seen at around the 1900 levels also. So for now, the technical indicators, neither the chart pattern indicates anything. So these make or break levels would be the levels where a fresh position should be initiated.
Okay, so it's a clear avoid as per Kiran. Sameet, yesterday media stocks were in focus. All of them surging in trade, be it a TV18 or a Dish TV or a TV Today. Anything that looks interesting from this pack? Probably a Z or a Sun. You can take your pick. But on the media pack, anything looks interesting?
No, definitely. TV18 certainly looks good. It has already given a decent recovery in last 3 to 4 weeks from its important support zone of 50. If you look at the monthly chart, it has been maintaining its hat of higher formation, and the stock is poised for higher levels from current position as well. But at current level, as a trader, I don't see any decent risk to reward ratio. So if this stock gives a decent pullback towards say 64, then probably one can look to go long for a target of 74 to 76 in probably next 3 weeks. And in that case, you have a decent stop loss somewhere around 60 rupees.
Okay. Watch out for the fertilizer names. DBT as a practice was being practiced in select pockets, and albeit found a lot of good response from managements as well as farmers alike. Now the CCA has decided to implement DBT across India. The modalities, I think, remain the same, but just the fact that the pilots within specific states having been so successful, CCA has decided to move across the country as well. Avinash, what would this mean? I mean, management after management has spoken very well about the pilots that were done and the benefits that came in. Is this a big boost, or is this more or less on expected lines?
No, this is definitely a big boost, and I think it would obviously mean better cash flows for fertilizer companies, and more importantly, companies which were not making extreme high kind of margins on the urea business. Companies like GNFC, RCF, Coromandel Fertilizer, these could be companies which could obviously benefit, but across the board, this is definitely a sentimental booster for most of the fertilizer companies, and you could possibly see some sort of improvements coming in, from the year FY19 onwards. Maybe in the next quarter, it may not be significant, but hopefully FY19 should be a much better year in terms of some sort of working capital savings and better cash flows.
Any view on future consumer? Whenever this big brokerage report comes in, that is the only day it reacts. Apart from it, we had this very interesting chart in which when Morgan Stanley came out with the note of target price, it spiked, then it fell down all the way. Then when Motilal Oswal came out with the report, it spiked and again it fell down. So I think it's a brokerage stock, but on the fundamentals, what do you make of it?
No, in fact, Darshan, it's a great business. They have a solid brand positioning and, the kind of footprint they have. I think clearly over the longer term, this is a growth kind of story, and in kind of a growth market, analysts usually give a very, strong kind of P rating for these sort of companies. So, yes, the business is definitely going to grow over the next, say, 2 to 3 years. But to expect that immediately in the shorter term, these stocks should outperform, it would take a long time. I mean, I would believe that only beyond FY19, one could see a strong earnings curve and operational kind of beat. So, I mean, longer term fine, but in the short term, the stock could obviously have its ups and downs.
Okay. Thanks for that, Avinash. I'm just smiling at the way Darshan asked the question. Nevertheless, the pre-open rate, let's focus on them. Just about to start, there's JS Nifty indicating about 0.25% downtick. Flat for the rest of the world markets that are trading right now. The first ticks, a big positive. I don't think this will happen. Let's wait for these rates to stabilize a bit. The Sensex probably showing a more believable note. Bring up the banks, the private banks first, because those were the ones that really took off in the last 45 minutes of trade yesterday. Everything from an ICICI to Yes to an Axis had a big surge in late trade yesterday. For now, seem to be flattish, but actually with the markets. If the headline numbers doing what they are, you wouldn't see it otherwise. Interested in seeing what's happened to OMCs. Remember, they came off quite rapidly after the surge day before yesterday. IOC, BP, HP should come up on your screen. In the green for HPBP. I think IOC has a tick of red. So again, inconclusive. Let's wait and watch what happens to these stocks. Aurobindo, I think Jayesh was talking about that stock on the Bloomberg terminal as a Bloomberg Edge indicator. For now, looking like starting off marginally in the green. Just want to see what Ultratech and Dalmia Bharat are up to amongst other stocks. And then Canfin Homes, one last name before I give it to Darshan. Unchanged right now for Ultratech. Let's get in Dalmia Bharat. Marginal upsides again out here. I think these are long-term upsides that come in if indeed they eventually go ahead and pip Ultratech to the post. Lenders seem to be back in their bid, and Canfin Homes too not reacting too much to the TOI note.
Okay, some companies that I want to highlight. Havells has made a tie-up with Hyundai Electric. It won't impact it too much, but nevertheless trading with a positive bias. Syntex Plastic Technologies allots shares to the promoters, so that will be interesting to watch. It's up almost 1.8%. Welspun Enterprises has said that NHAI to undertake rebidding for a Tamil Nadu highway project which they already had bagged. So news is negative, but the counter is reacting positively. Aditya Birla Capital, let's see how it's reacted on getting the approval for the ARC business. So it's managed to open in the green. Arvind will be in focus. I want to watch out for. It's no news, but one of the reports in the Business Standard said that it will demerge the branded apparel and engineering ventures. It's known, but Arvind has a habit to react to newspaper reports. So probably that. Let's take a look at Canfin Homes, how it has moved up in trade today. So it's trading up. There is Century Ply that I want to look at because of the CLSA report that has come in. Let's see, Century Ply has managed to open in the positive, and Crompton Greaves will be meeting a lot of fund houses today. So Crompton Greaves will be interesting. Let's take a look at Vakrangi also, 8 days of circuit, whether the circuit trend has been broken again on an upper circuit. So Vakrangi, Venki's is something that I really want to see. Yesterday I was up 10% in trade, whether the traction another 6.5%. This counter seems to be on a run. So there seems to be significant amount of traction in Venki's. That's what I'm spotting about as of now.
Well, some interesting names out there. Let's wait and watch what happens to these. Let's also try and get in a sense of what top brokerages are talking about today. Sameet Sarkar Johnson with the big brokerage calls for the morning. Good morning, Sameet.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is HSBC on Phoenix Mills. Now, the brokerage has maintained its buy rating on the stock, but has increased the target price to 730 from 720. Now, as the residential segment is remaining slow for the company's move to build office space is a sound strategy, says the brokerage. Now, also with RERA coming in and on the back of the shortage of grade A commercial office space, this strategy of moving towards commercial offices will be more value accretive for Phoenix Mill. Now, going forward, the brokerage is expecting the strong free cash flow generation from the company, as the commercial office space will generate rental income when completed and can be leased, which the brokerage expects to happen post financial year 2020. Lastly, it says that it still has a buy rating on the stock, as it expects strong rental growth to continue. Second, we have a CLSA on Century Ply. Now, the brokerage has maintained its buy rating on the stock and with the target price of 420. Now, according to the brokerage, there has been a shift in the Indian furniture market with moving preference towards ready-made furniture and medium density fiber over plywood. Now, Century, which is a late entrant in this market, has still managed to catch up with its peers. The company's new MDF plant has achieved quick production ramp up with current utilization levels at around 53%, which is expected to go up to 80% by financial year 2019. The new MDF plant has also achieved cash break-even, which is faster than expected according to the brokerage. Lastly, the brokerage says that MDF contribution to Century Plywood's consolidated revenue would grow up to 17% by financial year 2020.
Okay, so those are the important brokerages that we need to watch out for. Kiran, anything that looks interesting, the Nifty pre-open, after seeing the Nifty pre-open rates, anything that is catching your eye?
See, RCF is one counter that one should be looking at. A decent kind of correction has been seen on this counter, and a level from 110 to say 74. And yesterday in the second half, we saw a sharp pullback from 74 to 77. We believe that this counter has a potential to go up to 85 levels in a couple of days from now. With a stop loss of 75, one can go along with a 1 or 2 rupee risk. and rewards are pretty decent from current levels, which stands at around 85 for now.
Well, the fertilizer names certainly are revving up. I want to pull up Chambal, Nagarjuna, and Coromandel in particular as well. I remember A. Velayan being extremely bullish on this, even the pilots that they were happening within the DBT space, and if indeed this is extended all over India, the benefits that could come in. Remember, it's a stock that's had a very, very choppy last couple of months, as Coromandel has gone up all the way to 560, 570, and then has corrected quite viciously as well, currently trading at 500. Some of these names could be interesting to watch out for in the session today or over the course of the next few days. No immediate benefits. This has just been decided to go ahead with. It's a long-term thing. It will not have an immediate earnings impact, but certainly is a positive. IOC has a 4% downtick.
Yeah, because that's because it goes ex-bonus, I think. So IOC was down in trade yesterday also. The lot size also changes of IOC, but HPCL and BPCL seem to be doing well. They're up close to 1.5 to 2% each. So they seem to be doing well. Wipro has managed to inch up, is among the top gainers currently. It's managed to move up because of selling the business. Coal India is trading with a positive bias. NTPC, GAIL are trading weak in today's trade. So that's about it, what I can see as far as the pre-open is concerned.
Just about getting ready to settle down the pre-open rates as we speak, and we won't have too many big gainers or losers except for IndianOil, as Darshan stated, going ex-bonus. At the broader end of the spectrum too, MMTC, RCF amongst others, I think the entire fertilizer pack seems to be really okay for itself. Avinash, yesterday there was a bit of a surge in the media names. We've gotten the technical view already. Fundamentally, is there merit in trying to buy a beaten down Dish TV or maybe a Sun TV or some of the other broadcasters?
No, I think Sun TV could definitely be looked upon because, apart from the speculative stance, I think this company has a very strong positioning in the South market, and hopefully, post GST now, the kind of spends from the FMCG sector have also picked up. So I think probably we could see better, kind of businesses from the FMCG segment contributing to these media companies. But I think another stock which was in the limelight yesterday was TV Today. I think clearly within this space, it's a niche player, especially with so many by-elections and elections lined up. I think this is one company which runs the Aaj Tak channel and which actually drives a lot of revenues from these election-driven campaigns. So I think probably TV Today could also be looked upon from a long-term point.
Okay. Watch out for those media names. Some of these seem to have started off on a decent footing in today's session as well. In just moments from now, of course, we'll also tell you all that you need to know to stay ahead in trade today. By the way, just this move, I think it's a story that we've put out, Avinash, that there is a possibility that Maharashtra might consider waiving off property tax for flats which are below 700 square feet of carpet area, which would probably also include some smaller flats in the main region and not just the outskirts of Mumbai. 700 square feet carpet, about 900 square feet built up, is something that a lot of people live in, probably even areas adjoining to the upper rail as well, for that matter.
Yeah.
How big a boost, if at all, does it become for property transactions and some of the affordable housing-led companies?
No, I think it's definitely a big positive because we had seen that there was some sort of sluggishness in the real estate market, but the segment which you mentioned, Neeraj, I think clearly if this development actually fructifies and gets implemented, then I would definitely not be surprised that the affordable segment actually is within these kind of smaller pockets of sizes, and you could see a good kind of boost in companies like LIC Housing, typically a Diwan Housing. I think clearly my sense is even something like an HDFC also could possibly get the rub-off effect, because obviously funding these smaller houses would mean a larger volume opportunity, and which I think gradually, maybe in FY19 one could see a bigger impact of all this.
Okay, minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. Fertilizer stocks in focus as government says urea subsidy scheme to continue up to 2020 and DBT to be rolled across the country.
Cement companies are in focus as Dalmia Group says they have won the lenders' backing for Binani Cement.
Aditya Birla Capital says ARC business receives certificate of registration from the Reserve Bank of India.
ICICI Bank to sell 3.86 million shares of ICICI Securities in an IPO priced of 519 to 520 rupees.
Crompton Greaves and Vaibhav Global are amongst companies set to meet investors and analysts today.
And CLSA sees a 30% upside in Century Ply, while JP Morgan sees the risk-reward favorable in favor of Dr. Reddy's.
Well, interesting. A lot of those stocks, though not too many of them reacting in the session today. You know, I'm stuck with Darshan's question. I'm going to take it to our technical experts to try and talk about future consumer. A big bang move day before yesterday, cooling off its heels in yesterday's session. Sameet, Chavan, is there a trade in future consumer?
No, as far as near-term direction is concerned, clearly the stock has been maintaining its low top, low bottom formation on daily chart. So as long as it remains below 65, we are likely to see some kind of selling pressure happening. Once it surpasses 65 and sustains above that, then probably the near-term trend would change to positive. So until then, it would be a sell-on-rise kind of market, and I won't be surprised to see this stock, retesting its recent lows of 50 quite soon.
Okay, that's interesting. But I think the point is well made. The brokerages came out with notes when the stock was at 76, 77, went up I think to 82 or 83, and before falling so much. And at 50, that Motilal Oswal note giving that bit of a spurt. Difficult to figure out if there is more in store in terms of an immediate price movement or not. But I think that chart that I was talking about was pretty interesting. Every brokerage name, a bit of a spurt. And
there were two who covered it.
UBS.
There was UBS. I'm not sure they have
UBS.
A coverage. I think UBS is a target price of 85. Morgan had some in excess of
92.
Yeah, and 76 by I think Motilal Oswal. If you can get that chart up, it'll be very interesting to see. We don't have it now as per our producer. But look at the fertilizer stocks. I think that is the story of the day. Nagarjuna Fertilizer up 10% pre-open rates. There is Madras Fertilizer which is trading up. RCF is trading up. National Fertilizer is trading up. Fact is trading up. So fertilizer is doing well in today's trade. That seems to be the theme today.
Yeah, certainly seems to be the theme today. Almost all of the fertilizer names are in action, and not without reason, really. They seem to be, there is a fundamental reason why these stocks could do well. Kiran, Jadhav, since that seems to be the pocket that everybody's talking about and the pre-open rate seems to be bullish on, do you have any fertilizer stocks within your list of tracked companies which could do well? RCF, Madras, all of them looking to start off very positively.
I talked about RCF a couple of minutes back. The next stock that one should be looking at is Coromandel Fertilizers. The stock has been at a base which has a very strong support at around the 500 levels, and it has been moving and in this support zone for over 3-4 months. So now this same support has been retested. And we believe the kind of volumes that we saw yesterday was very strong. Buy at current levels with a stop loss of 490 does look good on the charts just because it's at the supports. And a pullback rally to around say 540 is not ruled out if you take a 15-20 days period from here on.
Okay, fair call. Kiran, apologize. I quite missed that call, but glad to get that entire set of stocks under the coverage. Let's take in the final top opening strategy from both our experts. Sameet, Chavan, your top stock for the day today.
I would go with Devi's Lab, which certainly looks good. So one can go long for a target of 1104, stop loss at 1029.
Okay, Kiran, Jadhav, your top call for the day?
The media stocks were there in the reckoning yesterday. So TV18 broadcast, we believe, will outperform for the day. Stop loss would be around 65, target would be 73 for the day.
Okay, so a couple of calls that are coming in from both our experts. Stay on, gentlemen. Maybe we'll take one final call post-market open, but 20 seconds to go. And suffice to say, if the mood in the pre-open rate is to be believed, we'll start off marginally lower. And the stocks worth talking about will be the fertilizer pack. That's entire space is looking like starting off on a very positive note. So at the broader end of the spectrum, that will be the focal point today. But here is how we're starting off. Flat, actually not too bad. Very, very flat. Unlike what the SGX Nifty was indicating. Let's see if we worsen the Nifty bobbing between the red and the green. The Nifty banked though about 0.15% down. The mid caps and the small caps, I reckon probably starting off marginally higher, but flattish. Yeah, marginally higher, but very, very flat in the session today. The heat map, maybe even Stevens, maybe a bit of a red overtaking the green. No, actually it's even Stevens. So no big moves, save for IOC. Tata Steel, IOC is a technical correction out here, but Tata Steel down about 1%. So this is probably that one big loser, but again less than 1%, and no big gainers either. Marginal gains for IT names like TechM, Wipro and TCS, but that's about it. Let's so essentially even Stevens between the red and the green, but very, very flat start to this trade session today. Let's talk about some specific names, 2 or 3 names that I want to highlight before I hand it over to Darshan. Bring up Canfin Homes, the bids on course. Today's TOI reporting about HDFC's bid, valuing Canfin at about $1 billion. Stock starting off 1.5% higher in trade. Fertilizers should be there. DBT now across India, RCF, National Fertilizers, Chambal, a clutch of names, some with reason, some with sentiment, moving up in the session today. So that's the bucket that you got to watch out for very, very closely over the next 15 minutes and maybe during the course of the day. And these are some of the top movers in trade yesterday. Starting off on a good note, save for Dish, both Sun and Hathway have a good start to the trading day today. Darshan?
Yeah, so basically some of the losers, Sheela Foam continues to lose, its sheen is down 8% as I can see currently. Auxilia Kale is the other one which is showing me a downtick today. So I think there's some confusion with the Bloomberg rates that I'm getting. But MMTC seems to be doing well. It's up 11%. The fertilizer pack seem to be doing well. Nagarjuna is up 10%. Future market is doing well. It's on a roll. It's up almost 8% in trade. So that is interesting. National Fertilizer has managed to inch up. State trading is moving up. So MMTC and STC usually move in tandem. So they have also moved up. Fact, Vakrangi, Hathway, Dollar Industries, IFB Agro. So some of the counters which have managed to inch up in today's trade. So that's something that we're doing as of now. As far as tech continues to be the big winner on the index, Wipro, Tech Mahindra are doing well. M&M has managed to inch up. So it's a flat day, not too much of movement happening in the broader market. Yes, there is, but nothing apart from it neither.
Yeah, just fertilizers which are probably standing out. Quick thoughts here. Sameet, anything that pops up on your screen?
HCL Tech is the one stock that we are liking. This stock has been consolidating in a range since last 3-4 days, and now it's on the verge of giving a breakout. So one can go long in HCL Tech also. We expect the stock to head towards 995, 1000 over the next few days. Risk reward is quite favorable, so one can go long with a stop loss of 956.
Kiran, anything that pops up on your screen?
A couple of stocks which look really good. One is Havells. Havells, for that matter, was trading in a range, a tight range of say 10-15 points. And today, since morning, the stock is above its crucial level of 522. So we believe that there is a good kind of potential if the stock stays above the 520 mark, and on the higher side we could see the stock go to around 546, 540, 550. These are the levels of resistance from here on. So we need to watch out for around half an hour from now if the stock manages to keep itself above the 520 mark. The second stock is Whirlpool. Again, here we believe that the kind of move that we saw yesterday would move forward from here on, and the consolidation that we are seeing for the last 3 days, we will see the stock go to around 1640 in a couple of days from now. A buy recommended at current levels with a stop loss of 1560 for a target of say 1640 from here on.
Okay, gentlemen, thank you so much for joining in today and giving us your perspectives. Much appreciate you taking the time out. Let's get in a very special voice. Sanjeev Prasad, Managing Director and Co-Head at Kotak Institutional Equities, joins us right now on the show with his thoughts on what could happen going ahead. Sanjeev, much appreciate you taking the time out, and good morning to you. Lots happening, Sanjeev, within the political circles, yes, and giving cues to the market. Yesterday, Urjit Patel giving out a very passionate plea about how it's very difficult for the regulator to go out and plug all holes within the PSU banking system unless some moves are taken. You know, how is sentiment looking like for investing within India and within the emerging market universe currently?
I guess you need to break it into how domestic investors are looking at India versus how foreign investors are looking at India. I guess most people still like India, but they would like the valuations to be somewhat cheaper, especially for the good quality consumption stories, including the private retail banks, which are all trading at fairly high valuation. So if you look at foreign investors, they have been somewhat cautious in India for the last 7-8 months, given the fact that A, there are better opportunities available elsewhere, I guess, from a valuation perspective, and B, other markets have been far better performers over the last 12-15 months. If you look at their MSCI Emerging Market Index, in dollar terms, that's 30% return over the last 12 months. India has done decently, 20% return, nothing to be sneezed at, but obviously it's much lower than the returns for the emerging market. And China delivered something like almost 50% return over the same period. So people are looking at other markets more favorably in the emerging market space. If you come to domestic investors, obviously they can only invest in India at this point in time. So they're somewhat more positive stance dictated by the fact that A, they can only invest in India, and B, they seem to be still getting a fair amount of inflows. At the same time, of course, you are seeing a lot of noises in the background with respect to the macro have been deteriorated pretty significantly over the last 6 months. Bond yields have gone up sharply. And of course, the political environment has started to look slightly more uncertain compared to where we were a few months back. So all that put together is making investors slightly more cautious. When I say investors, more the foreign investors is more cautious in India at this point in time.
If I distill the news and if I try to pick out the green shoots, while the bipoles may have had the ruling party getting the jitters in the larger elections, they're able to hold their fort well. And if I just look at what the recent releases on the macro front have been, and please correct me if I'm wrong here, but the CPI-IP numbers 2 months in a row, the last 2 releases in a row, seem to be in favor of maybe a more benign core inflation and industrial activities showing visible signs of a pickup.
I would agree with that. Clearly over the last 2-3 months, you're seeing some positive signs for the economy, and that's something we have been highlighting also, that the confidence seems to be coming back among the companies. We're starting to see some investment on the private side also, with some investments picking up in cement, refining and steel, so that's a good sign. On inflation, anyway, we are not really looking at any rate increase by the RBI, so even if the numbers are coming on the lower side, I don't think that's sufficient for a rate cut anyway. If anything, that takes away any possible chance of a rate increase. We'll have to anyway watch the next few months and see what happens to inflation. Do keep in mind the fact that we're headed into a season of some amount of uncertainty, given the fact that you will have some idea of monsoons as to how they will play out in the next Kharif season, and more importantly, how does the government approach the whole situation in the rural economy? Do we see a reasonable amount of increase on Kharif MSP prices? So we'll have to wait and see how the situation evolves in inflation going forward. So our stance has been pretty clear on this one, that we do not see any rate increase with RBI, at least in the first half of calendar 18. After that, it will all depend on how inflation pans out. So that's a positive sign. The problems still remain, I guess, in the sense of, if you look at the broader macro picture, GST revenue is still looking somewhat subdued. The hope is that over the next few months, post-implementation of the e-way bill system, revenues will start picking up. But as of now, we are running well short of the requirement for fiscal 19 for GST revenues. Also, oil price is $65 a barrel, not very comfortable, I would say. So the hope is that eventually things will pan out better in terms of the macro, with inflation generally staying benign or undershooting the expectation of the market, GST revenues picking up, and oil prices cooling off somewhat, let's say low 60s, high 50s. If that situation plays out from a macro standpoint, that's a lot of positive news for the market. But these are macro variables, very hard to get a good handle on. Things could probably go the other way also, for all you know. So let's see and see as to how this situation evolves over the next few months before we can start feeling more comfortable on the macro front.
Okay, Sanjeev, hi, Darshan here. You had come out with a note late February in terms of valuations. You found them expensive despite the correction. Since that time, there has been a much more deepened correction that is coming in. Are valuations fair according to you now, or still do you find them expensive for India?
When you talk about valuations, there is no point looking at the broad market valuations. Ultimately you look at the bottom-up valuations across sectors and stocks. So for whatever it is worth, if you look at the Nifty 50 index on a top-down basis, and I never recommend looking at the market as a whole, it's at about 17.5 times on a March 19 basis, and that is after assuming 25% earnings growth for the Nifty 50 index, which is what we are projecting for March 19. So the market is exactly not cheap. On March 20 basis, assuming we see another 15-16% growth in March 20, then it is trading at about 15 times. So maybe looks okay, but whether we will see the kind of earnings growth that we are projecting, that remains to be seen, especially after the developments in the banking sector, where we do expect the earning numbers to be cut on the back of higher provisions for some of the banks. So that's on a more top-down basis. If you look at on a bottom-up basis, and that's where the real challenges come. The stocks which have fallen are stocks anyway where there was some, I would say, little amount of interest, and some of the PSU banks, the so-called private corporate banks, metal mining names, etc. Some of these are based on developments which has happened with respect to the US imposing tariffs on certain products, so nothing to do with India in that sense. And whereas, if you look at the good quality consumption stories, whether they are consumer staples, consumer discretionary names, and private retail banks, the better quality NBFCs, they are not really corrected. They are still trading at very high valuations, and maybe there's a reason for them to trade where they're trading. And that's where the whole problem is at this point in time. What investor would like to own more of? Obviously, they are fairly expensive. And you are seeing correction in areas where the interest is somewhat limited at this point in time. And unfortunately, the bad news keeps coming in the sectors where valuations look okay. You start getting excited about those stocks, and then some more bad news comes. And this is what we have been seeing in some of the corporate banks and the PSU banks over the last several years. So it looked like we're coming to the end of the NPL problem, with most of the large NPLs being recognized by the banking system. We have started to see a lot of progress on the resolution of the NPLs also, especially the large, assets. But suddenly you have a situation where the whole sentiment has soured because of some of the scams which have come out of late, and also the announcement by the RBI to remove some of the special dispensation which are available for the banking system.
Sanjeev, you had a conference recently. What was the broad feedback that you got, both from the client side as well as company side, on the macro as well as the micro of the country?
Pretty much what we discussed. So everybody was of the view that there seems to be some recovery as far as the micro is concerned. Companies were generally reasonably confident about recovery, and they were seeing also the third quarter numbers, which generally look pretty decent on a YOY basis. You started to see some signs of companies becoming more confident about investing, looking at the demand environment, etc. So on the micro side, there seemed to be some amount of optimism. Investors generally seem to be fairly comfortable with the earnings scenario. Obviously earnings numbers are disappointed for the last 3-4 years, but this time around there seems to be a lot more confidence in earning numbers. But this was before some of the banking related issues really started coming to the forefront, and now there are some question marks about the earnings of the banking sector, at least for the first half of fiscal 19. On the macro, these are concerns which everybody recognizes, but I don't think at this point in time investors are really pricing the macro risk to the full extent, and you can see that in the big divergence between bond yields and earnings yields. It's not as if earnings yields have moved a lot, in the sense PEs have more or less held up, whereas the bond yields have gone up pretty sharply over the last 6 months, or something like 120 basis points increase. So the bond market is clearly worried about the macro, whereas the equity markets is somewhat more relaxed about the macro, probably under the assumption that things would improve going forward, with GST revenues picking up, oil prices cooling off, etc. So let's see. I would say the mood was, using a term which has been beaten to death, I guess, cautiously optimistic.
Well, yeah, and let's hope from a bull's perspective, Sanjeev, that the equity markets are listening into the right cues and behaving in the right fashion. But understand we have to thank you. You have meetings at hand, but thank you so much for taking the time out and speaking with us today this early in the morning. Appreciate your time.
Thank you.
That's Sanjeev Prasad of Kotak Institutional Equities with his thoughts on the markets and everything beyond. By the way, the markets by themselves are not doing too much, but the fertilizer pack as a whole is doing extremely well. Remember, the CCA will implement the direct benefit transfer, or the DBT, for fertilizer subsidy payments across the country, and has extended the urea subsidy scheme till 2020. To give us a management view on this, joining us on the phone line is A.B. Khare, Chairman and Managing Director at Madras Fertilizers. Good having you, Mr. Khare. Thanks so much for joining in. Splitting it into two. Firstly, this subsidy extension. What do you make of this, and what kind of an impact could it have?
See, I don't know what is approved because yesterday I was not in touch with the TV. You are saying a subsidy extended?
Yes, till 2020, sir.
Till 2020?
Yes.
What is the meaning? I am not knowing because there was a the urea subsidy is there. They are not increasing the subsidy. They
No,
are not
sir. So the
subsidy.
CCA, sir, the CCA is continuing the urea subsidy scheme from 2017 up to a period of 2020. I believe that extension period was not known, and now they've extended it all the way to 2020.
No, I feel there was one proposal was there in CCA that might have got approved. That is means there was a proposal initially last year or 2 years back that up to 18 they can run with the same energy level.
Okay.
After 2018 April, that was supposed to go to lower energy level. That they might have extended.
That they've extended, they haven't gone ahead with any kind of increase, sir. There is no increase in the prices of
decrease of energy level in urea.
Yeah, and no increase.
That is what I assume. I'm still not knowing what is the subsidy. I have not read those things.
Okay, fair.
So that was a proposal. Yeah, that was a proposal to decrease in energy consumption norms for urea. That may not. That has got extended another 2 years. Means the urea manufacturer will get subsidy at same rate.
Okay.
Whatever rate it is going on. So that might have got extended. That is what my assumption is. I don't know whether my assumption is correct because I have not seen the details.
Agreed. Mr. Khare, in which case I won't bother you with that question. But I will tell you about the DBT. Right now, they've agreed, the CCA has agreed to extend DBT across the country. Now, I presume that earlier there were pilots carried out in certain states. Now, with the confidence in the pilots, it's been decided to extend it across India. I would presume again that this is a big positive.
So, yes, DBT is phase 1. This we call it a phase 1 because still subsidy will be given to manufacturer. This all over India they have now implemented. Some state was implemented in December, some state in January, some state in February, and February onwards almost all the entire India is coming under DBT scheme. DBT scheme is what it is that once you sell the fertilizer to farmer, then you get a subsidy.
Yes.
There are positive points of it as a manufacturer's point of view that you will get subsidy within 7 days. There is a negative point of it that you have to wait for seasons to sell the urea to farmer. So positive and negative, suppose they cancel it out each other, then it is almost because we used to get subsidy.
Mr. Khare, if I can just come in, one quick question. I mean, the previous managements that I've spoken to over the last 6 odd months seem to be fairly happy with the DBT simply because it helped resolve the cash flow issues. Now that it will be a pan-India play or a pan-India process, you don't think the positives outweigh the negatives? You are not of that opinion?
See, the positives are that you get the 100% subsidy within 7 days.
Right.
That is very positive.
Right.
Negative is that you have to wait for the season when you are able to sell to farmer because normally Rabi and Kharif is two main season. Apart from other seasons, minor where sales goes down to slightly lower level.
Got it.
While earlier we used to produce every month and we used to dispatch the material to field and we used to get subsidy. Now we have to basically wait for the season to sell it to farmer and then get the subsidy.
Okay.
But overall, I feel it is a positive thing. And ultimately, the second phase of subsidy, when subsidy will be given to farmer, we are waiting for that phase.
Okay.
Because then we'll be totally away from subsidy thing. We will get whatever we are producing plus profit. Cost of production plus profit we will get from farmer.
Right, sir.
And it will be he who will be getting the subsidy.
Okay. Fair call, sir. Thank you so much for joining us this early in the morning and giving us that quick perspective. Much appreciate your time. That's the CMD of Madras Fertilizers speaking about the DBT extension. Doesn't seem to be quite impressed with this whole thing as well. He's waiting for some more changes to come in. But the pack, by and large, the entire fertilizer pack seems to be doing really well. However, we take a quick break. On the other side, a discussion that I'm really looking forward to. Would the changes that we're seeing in the digital and the media and the entertainment space really help platforms which either create the content or distribute the content? Will all of these changes help them monetize this content in a big way? We speak to the industry veteran Sameer Nair. He joins us on the other side.
job, अरे 5 to 9 job, भाग दौड़, all the time job. The roaming wala job, the deadline wala job, or are you living in the market wala job?
Life is full of options. Choose a job and earn on your own terms. Choose to become an LIC agent. It's more than a job. It's career insurance. Be your own boss. Be an LIC agent. Ab life set hai.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much. They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution है. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
On 26 November 1949, the Constitution of India was adopted, recognizing liberty, equality, and fraternity as the principles of life, which cannot be separated from each other. The government of Karnataka has imbibed the ethos of the Constitution by developing programs and policies aimed at creating a socially, economically, and politically just society. Karnataka's flagship programs such as Maitri, Annabhagya, and Arivu have created an equal opportunity platform for all, irrespective of their gender, economic, or social status. Karnataka is committed to encourage education through various welfare initiatives, ensuring equal status for women and empowering minorities to uphold every individual's dignity. In the last 4 years, Karnataka has formed 462 new Gram Panchayats, which has taken the principles of democracy to the grassroots levels, and our Progressive Vision 2025 document engages public government participation to build a better state for all. Karnataka's collective vision to endorse fraternity, justice, and equality has transformed into Karnataka's model of development, which is based on the tenets of the Constitution.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Thanks for staying with us on Bloomberg Quint. You're watching IndianOpen. The equity market's lying flat, but the conversation that we have next is on the digital wave. How will it, I mean, it will, everybody believes it will help the media and the entertainment business become a 2 lakh crore industry by 2020. That's according to a report put out by FICCI in association with E&Y. Digital media, in fact, expected to overtake the world's largest film industry, that is Bollywood, by that time as well. So there are interesting tugs and pulls and pressures, and to discuss about the opportunity and the casualties, if you will, in the sector, who better than industry veteran Sameer Nair, CEO at Applause Entertainment, joins us right now in our studio. Sameer, thank you so much for taking the time out. It's been a long time, so thanks for being with us today.
Thank you so much.
So, what do you think? I mean, you know, it raised eyebrows. This article that we put out, which was essentially a republishing of the report, suddenly got a lot of people writing back to us that this was great and we didn't know about it, and you know what it could do to established industries, and we've already seen signs of that happening. How are you viewing this in a year and a half, 2 years of a bunch of OTT platforms already coming to the fore?
You know, actually what happens in our media business, and you've been in the business as long as I have, is that nothing ever happens in isolation. So it's all what I call overlapping universes. You know, so like as we evolve as a society and as all of it grows, new things keep coming up, and old things don't necessarily die out so fast. So like today, as we see, print is still growing, outdoor media remains effective, radio is still really powerful, television is growing, and films have progressed, theaters have gone down, and now on top of this OTT has come, right? So I think all of it is happening together. The big deal in all this, what's happening, is that it's putting a lot of pressure on the quality of content. You know, rather than like every time any new medium comes up, the sense is that will it destroy an old medium? I don't know whether it really destroys an old medium as much as it puts pressure on storytelling per se, you know, in your business on how well you report the news when there are so many avenues to receive news. There are so many different ways to get that information. So how do you stand out and how do you sort of, be that way? So I think that's what's the pressure that's coming up, that you're talking about going from, what used to be 10,000 to 15,000 movie theater screens to today 165 million TV homes, which is about 200 million screens, to then 600 to 800 million mobile screens. Yes. You're talking about that many number of screens in front of people, and people engaging with these screens in different ways, and yet consuming the same content. In a sense. Yeah, right? True. So I think the pressure is coming on that, on the content creating ability and how different then businesses approach it. That how do you approach it? So like, do you therefore regard film as film, or do you regard your consumer first? What are you doing in this?
What do you think people are doing?
Well, typically how it goes, as always, is that old media first adapts to new media. So like what all print did was come to TV and then come to digital. So you can get most of your news and information on a Twitter feed or a WhatsApp or Facebook or from everywhere, from the internet basically.
Yeah, we are on the internet. Bloomberg Quint is only on the internet, right?
Yeah. So you don't need to be in front of a TV or have a whole newspaper in your hand. Ditto, what the broadcasters are doing in entertainment is redistributing their content via the digital medium. So what you can get on TV, you can also get on Hotstar. So that becomes the first adjunct. And then the third thing that emerges out of this is people come up with ideas like yourself, which is let's be digital first, let's be a digital native, let's be born and bred in digital, and let's create original for digital. Yeah. And I think all these three will coexist and work. And finally, as a consumer, there's a lot of talk that happens about data as the new oil. I don't know so much about data being the new oil, but human attention is definitely the new oil. I read it somewhere, and it's always been and always will be. That finally our fight is not for anything but attention and engagement. You know, if the more people who watch this today is that much engagement, you know, it's not going to be how they saw it, through what device, were they in their car, were they in their house, you know, it's that share of time.
True. Okay. So let's try and talk about avenues which probably get a larger share of time. Business news is a smaller audience. Right. Let's talk about general news or general entertainment. Right. Let's put it that way. And trying to get a sense from you as to one is whether human attention is now slowly but surely shifting away from a television screen in front of you or going to a movie hall to watch it, as opposed to watching it at your convenience. Now, you know, the people that sadly we interact with, it's a bit of an echo chamber. Right. Almost everybody is in that space. You probably have a sense of what's happening across the country. Right. What is happening across the country?
I think what's happening is that, you know, like when this whole mobile revolution happened and the small screens came out, there was this big, you know, furor about, you know, that now everything is going to be consumed on the small screen. It is typically the human sort of, you know, human behavior that as you progress in life, as you get older, as you get richer, as you get more comfortable, you go for bigger. You don't go for smaller. So like, for example, when we talk about, you know, we are moving away from TV screens and to OTT platforms, I do 99% of my Netflix consumption on my TV, right? In a sense. So the TV is actually just a device now. It's not necessarily the broadcast channel.
Right.
Similarly, all these things, like, you know, like people are still going to theaters. The reason we don't go to theaters is not because we don't want to go to theaters, it's because the experience is uncomfortable. Right? Why is the movie theater business still big in the US? It's a 100% market, penetrated market. They've had, you know, high-speed broadband for the longest time, right? They should have been the first casualties of the movie theater business, but they're not. They still do a $1 billion box office revenues and that kind of thing, because the experience is okay. Right? The experience is, people like to go out for movies. They like to go out shopping. They like to do these things, you know. So I think we mistake these changes by saying, like, you know, okay, so no, a bulk of India would have seen a pirated Bahubali on their mobile phone. But that is also because they either can't afford the theater or it's no fun to go there, you know. It's one of those two reasons. Or it's not even there. It doesn't even exist. See, India also has this problem that movie theaters don't exist. We've got 10,000 theaters for a country of 1.2 billion. The US has got 40,000 theaters for a country of about 300 to 400 million, you know. So you're talking about, you know, at a ratio, we don't even have enough theaters.
And in a country which doesn't have too many other avenues as opposed to the US.
I mean, if nothing else, forget avenues for entertainment or anything, I'd just say that we are a tropical country, hot, muggy, humid. If nothing else, have a theater with air conditioning. I think everyone will show up and sit in the theater, reduce crime, reduce everything, and we'll just hang out for 3 hours watching some mindless entertainment, you know?
Okay, so that is one, the reach. Two is the ability to be able to monetize it. Now, what's your thought here? There might be, digital might be growing at a rapid pace. Do you think the ability to be able to monetize this content would grow as well? As of now, there is little evidence to prove that digital can make those big bucks. Sure, people are making, taking baby steps in getting revenues, but what's the sense that you get from advertisers? Are they looking to put in big bucks into digital? Because frankly, the reach and the number of views on digital, in my experience in this 14 years and in the last 1 year in being pure digital, is that the reach and the number of views is far higher on digital.
It is. See, the thing is monetization, there's a lot of, there's a lot of talk about monetization. But again, it comes back to first intention and engagement, right? Time spent is the most important thing. Okay. If you look at any industry in the world, finally, when you look at industry sizes and you measure it back to time spent, it's either time spent or daily usage, right? Why is petroleum so big? Because we use petrol every day. Right? That's what we get up in the morning and put do it, use it, right? All the Facebooks and all these companies are big. Why is your iPhone, why is Apple such a big company? Because we use it every day, right? Telecom is because we use it every day. So this monetization, what's happening is that, see, models will be found, right? You're looking for customer engagement, right? So models are the ad-supported, original, you know, advertisers will support, and I think Google and YouTube are making a lot of money in India. You know, they dominate the market, and in their search and all those categories, they are like making serious amount of money. They're making more money than some broadcasters, right? As a group, right? Now you can argue that an individual person in the Google universe or in the YouTube universe is getting peanuts. That's because YouTube as a company can deliver 4 billion impressions this morning. But you as one of the people who are contributing to those impressions gets your 5 paise per view or, you know, whatever you get. So that's the ad-supported model. It'll keep growing because advertisers go chasing where consumers are, and they value it in different ways.
So therefore, will original content creators who might spend a lot of money in creating the content, or distributors of content as well, which may eventually use Facebook or YouTube for that matter to, or Periscope to essentially make the content reach more people, be able to make big money, or will it be dominated by these giants?
See, what happens is that genuinely, if you're doing original created content and if your content is good enough, you must put it behind a paywall. Right? You must. I mean, that would be just what is expected of you to do that. So there will be the advertising supported model, which is your YouTube open platform, and it's tough. It's very difficult because, to make any sensible money, you got to get into millions of views, and millions of views are not easy to come by. There are billions of pieces of content. Discovery is hard. All of that is hard. It takes time. Plus, it's a long tail kind of thing. Subscriber supported content is stronger, powerful. Netflix is a great example of that. That's how that model works. Then there are two other things that have emerged actually, and that's why I don't worry too much about monetization. One is what I call the e-com supported model. In many ways, Amazon is what? Amazon is a big e-com company that reasons I sell so many things, I might as well sell shows. I might as well sell some video. And I package it, with an overnight delivery and this and that. So that's a different funding model. You can't really say that for every show that Amazon puts out, did they actually make the money for it, right? It's an overall package. And then there is the data supported model. Now you've got the big telecom companies who, they require you to not consume data, they require you to guzzle data, right? So when you're going to guzzle data and you're going to make up, do it in that manner, it will be packaged in that sense. Tomorrow you might have a e-wallet supported model, It's different industries converging, coming to getting a consumer engagement and maybe packaging all sorts of things with it. What content creators have to do in whatever context is that you have to still deliver that stickiness.
Yes.
Because no matter which model I'm working with, right, I've got to finally put it out on a screen to consumers and they must consume it. Right?
Okay, so here's my question, Sameer. Let's say I'm a consumer sitting in India. I have a subscription-based model in Netflix. Then there is Amazon. And you made a very important point, e-wallet based models. What if hypothetically a Paytm thinks that for all my subscribers who are coming to me, I'm also giving them for 300 rupees a package for the year, right? And there is enough good content available on all. You can argue that almost everybody says that Netflix is in a different breed, the others are not. But what about the rest of the pack who are making content in India and have a subscription model? Right. Will those survive when bundled up offers will only become larger?
Well, what happens is that finally, no matter what the size of the platform, you have to still create the content. Sure. See, the big story of Netflix's success is that it got built on the existence of a US market, which has been doing this kind of content for the last 25 years. Right? Now, when you arrive in India, it doesn't exist. If you come to India with $1 billion and say that I'm going to buy all the premium content and aggregate it and put it out there, surprise, there is no premium content to buy. Right? Because we missed that evolutionary step. We never had our HBO and Showtime moment. We've been doing primarily daily soaps on air for the last 20 years. So this market in India has got to be built ground up, right? Now, in building it ground up, sure, you can have an aggregated model, you can collect it from different places, but finally, all this content has got to be created, and pure size is never going to do that, which is why when you take the movie industry, you have the biggest studios and then you have the sleeper hit. Right? And you always have the sleeper hits in everything. And for that matter, the big studio puts out the big show and it just sort of fades. And marketing is not the solution to this. True. Because what we are increasingly finding in our digital world is word of mouth. Word of mouth, right? It is not marketing. The big billboard in Bandra is not going to cut it. What has to happen is that I have to tell you and you have to tell 20 more, and that viral, that thing is what drives it. So, and content is like that. I'll watch a show because you recommend it to me. I regard you, it's a peer validation. You tell me, hey, check this out, then you check it out.
Is there a short formula for success then? Or is there a method that we can safely say is working right now? Because peer-to-peer is quite unpredictable. And part two of my question would be, Sameer, out there is that in light of all of these uncertainties, I'm loosely using the term uncertainties right now, will so many OTT platforms survive, or as a natural course of business, some will fall by the wayside?
They will. Actually, see, in any industry, there'll be winners and losers. That was there in TV, it was there in print, it's there in every business. So in the same sense, this whole digital business will have its winners and losers. We don't know who are going to be the winners and losers now. Today, as we speak, it looks like some people have advantages and some people are too small, too weak. How are they going to make it in this big money war? But as we've seen in the media business, it's rarely money that solves the problem. You know, it's always the ideas that sort of cut through. It's never the money. So I don't know. I mean, there will be winners and losers. So not everyone will survive. Not everyone should. I mean, you know, I think there will be a degree of aggregation. I think a degree of, you know, consolidation will happen, which is good. If there is some level of creative consolidation, it will be a good thing to happen. The way we're building out Applause is to essentially create the content and then look to work with platforms. Because my reasoning is, if there are so many platforms, you still need to feed the consumer, right? You need to put out shows, you need to do all that, and you need that stuff. You know?
And quality.
And you need quality, and you need a lot more. I mean, if you look at the Indian OTT market, and if you look at in between Alt and Amazon and Netflix, which is still to come, and you know, TVF and AIB and Voot and Hotstar, combined, I think the market has produced 20 shows in the last 3 years. 20. I think the market's good for 1,000. Maybe 2,000. You know, this is limitless, right?
True.
Because you're not going to watch everything today. You binge watch it, you consume it at your time, word of mouth builds, and over time it happens. You know, the capacity is huge.
Okay. My last question, Sameet. You mentioned some bits of it. Right. Pay for content. Do you think that is where we will move to in 5 years? And will an Indian consumer be happy with the pay for content when there is so much of free content available? Because somehow we've seen that Indians, and I don't know if I'm wrong here, and I don't know if your experience is different, but Indians are very price conscious.
Indians are price conscious, but Indians are not cheap, and Indians pay. Indians pay actually for everything. You know, I always have this example. It's actually comes from our basic religious roots. See, Hinduism is a transactional religion. When you go to a temple, your default, you know, you put money in the puja thali, you look up to God, and it's the only religion that still does this, you know, as in a very definitive connection to paying. We pay for everything. We've paid for cable TV from day one. Maybe the broadcaster didn't get it, but the cable guy took it. And if you didn't pay your cable guy, he cut it, right? So you've always paid for TV. You've paid for everything. You know, there's not, when you think about it, there's very little you get free. Now, if you look at YouTube, and you say YouTube is built on this model where you get all this free content, but it's a lot of user-generated, a lot of pirated, you know, that kind of stuff. But the minute content becomes better, right, the minute it becomes this thing, people will pay for it. The Wall Street journalists pay. Yeah. You read 4 or 5 articles free, and then you pay. You pay for the Financial Times, you pay for so many things. Today you pay for sport, you pay for your Tata Sky package. You're already doing that. You're anyway paying for data when you think about it. True. It's not free. So we have this notion that Indians are cheapskates.
No, I mean, not that much.
And I think
price conscious maybe.
No, like people pay for movies, right? When you know full well that the movie is going to come on TV, for a package you've already paid, you still go to the theater and see it. Because you'd go and see it because you want the experience. You want those things. So I think as long as the onus is on content, I think we put too much, you know, we put the pressure onto the consumer, we put the pressure onto the medium, onto the advertisers. I think the onus is on content.
So pay for content could well be a reality, and it could be a successful reality in India.
It is already is, and it will be. Actually, when you look at TV, advertising and subscription.
No, on digital, I mean.
No, if TV on 20 years has reached a 50-50 advertising and subscription, I think digital will go faster.
Okay, great. Sameer Nair, so good of you to take time out and join us today. It was really nice having this chat. Thanks for taking the time out and being with us today. Right, and that's all that we have on this leg of Indian Open. Viewers, thanks for tuning in. But stay tuned. Up next is the FNO show.